Thank you. Thank you. Good morning. Thanks for joining us this morning. This is our last session of the Insurance Summit, unless you're attending one of the workshops. So thanks for being here this week. My name is Erin Campbell. I'm the Regulatory Research Services Manager at the NAIC's Center for Insurance Policy and Research, and I'm pleased to introduce our speaker this morning. Dr. Unal Tatar is a professor in the Department of Cybersecurity at the University at Albany and has over 20 years of experience studying cyber risk analysis and management. Dr. Tatar is also one of our NAIC CIPR Research Fellows, and our Research Fellows program is designed to foster new and innovative research in insurance regulation by providing resources to researchers who are working in this field. His project with us is on response strategies for catastrophic cyber risk, which he's going to talk to us about today. So with that, Dr. Tatar, thanks.
Thank you, Erin, for the introduction. Good morning, everyone, and thank you for coming to the last session of the day. I will talk about the catastrophic cyber risk and insurance. This is an important topic today because we know that cyber incidents are almost our life every day, but the catastrophic cases are kind of imminent because we have some near misses events and the interconnectedness of the systems are getting higher continuously, so this can bring a cause a systemic cyber risk and cause a catastrophic cyber risk, and we need to be prepared for it. So in my talk today, I will present this topic in 3 parts. In the first part, it is about the cyber insurance from a historical and evaluation perspective. This is important. If we understand how cyber insurance evolved over time, then we can understand what we can do now and how it can continue its evolution. And cyber, in this part, I will talk about the types of cyber risk and the different mechanisms for transferring cyber risk and risk pricing methods and data sets briefly. In the second part, I will talk about the catastrophic cyber risk and insurance, what specific factors and conditions elevate to make it an incident, a catastrophic cyber incident. And I will give some examples from the near-missed events and the realistic hypothetical scenarios results and loss estimates to give you an idea what an event, a catastrophic cyber event looks like. And the last part of this, the last minutes of this part, I will talk about does the current cyber insurance sector possesses necessary capacity to address the potential catastrophic cyber incidents. And the third and final part is I will discuss different mechanisms for government intervention for catastrophic cyber incidents like a federal backstop. So let's start with the first part. I want to start with defining the cyber risk because cyber risk is not just one type of risk. There are different cyber risks, and each of these types requires different modeling and pricing and mitigation strategies. The first one, maybe the easiest one to handle, is idiosyncratic risks. These are the risk incidents that happen and affect the individual policyholder, independent from what happened to the others. And think of it like a company which an employee makes some mistakes and discloses some private personnel information or client information. This is specific to this company, and traditional techniques like loss distributions and expected value pricing works very well as actuarial methods to model this risk. The systemic risks are different than the idiosyncratic. They affect multiple firms at a time because of a vulnerability they share. So there's a correlation, but there is no contagious effect here. So again, the actuarial methods still works here. And the third one is systemic risks, which are more difficult to model and also have a higher impact than the other two. These occur when the risks spread contagiously across interconnected systems and when the adversaries strategically target these systems, such as a cloud failure. For example, when AWS is down, then it will affect maybe the 1/3 of the whole country. In this table, you can see some examples. I will not get into all the details. For example, an example for an idiosyncratic risk is a business email compromise. Someone poses like the CEO sends an email and asks the accounting department to wire money to another account. This is just about the individual company. When we look at the systematic risks, for example, this is a ransomware attack which targets the exploits a vulnerability which is common in a software used by the banks. So the bank sector can be impacted, but still it is not a systemic event. In the systemic one, like a strategic supply chain compromise, which a malware is integrated into a software which is used by many companies, assume that the Microsoft Office, if someone adds an update which can be a malware, then everyone in the world will must be affected because of that. So, or a massive cloud outage, as I said before, can be a huge impact. So after this brief introduction, let's look at the evolution of the cyber insurance. Cyber insurance is a tool used for transferring the risk. And first, we see the cyber insurance as a product after 1997. I use this timeline based on the Josephine Wolf and Daniel Wood's study because they made the most comprehensive analysis about that. So I created this chart based on their classification. In the first part of it, you can see that the traditional era, the first almost 9-10 years of the cyber insurance is trial and error phase. The second phase is data breach notification era. And after that, after 2018, it became a ransomware era, and it continued until 2023. And reinsurance offered as a product after early 2000s, and cyber warranties. It's not cyber insurance, but it's a tool for cyber risk transfer and sometimes backed by insurance, cyber insurance. So it started after 2013. More innovative solutions like parametric coverage. We see the first parametric cyber coverage after 2019 and cat bonds after 2023. Let's get into the details of these eras. The first one is the first phase of traditional cyber insurance coverage from 1997 to 2006. At this time, the companies decided to offer a cyber insurance product, but there was no consensus about what to cover. For example, Chubb at this time thought the focus should be media liability, which means things like online publishing risks. Meanwhile, AIG more focused on the business interruption from denial of service attacks. Marsh, a broker, created a different product which covers downtime from hacking, fraud, and viruses. So there were no consensus about the coverage, but mostly it was the first-party coverage. The affected party will be covered. And at this time, there was no data because it's just starting. So they mostly relied on the audits or analogies. For example, if a denial of service attack happens, how long will it take compared to a fire? So they asked this kind of questions. With these analogies, they tried to quantify the risk. And then they conducted interviews with chief information security officers, and they made many guesses. It was not very reliable, but this is how it started. And when we look at their solvency standpoint, their claim exposure, mostly smart portfolios, low limits, high margins for some early riders. When we look at this time, the AIG reportedly made $100 million of sales and with just 11% loss ratio. So it was great at this time because they wanted to play it safe. And there were incentives at this time. If a company buys an insurance and they allow the carrier to check their systems, audit their systems, they get discounts. So it also incentivizes good security control adoption. In the second phase, the things changed because of an external factor. Many states started to pass the data breach notification laws after 2007, and the coverage shifted from first party to third party because because of the cost of the handling these regulatory fines, legal defenses, settlement expenses, or PR firms, bridge coaches. These kind of things changed the direction, changed the coverage from first party to third party. And at this time, especially the large companies, they wanted to buy cyber insurance because they have huge personal information data, and a data breach can be very costly for them. And they wanted to coverage more than $50 million. But the insurance companies were not ready to sell it, and the tower mechanism came into play. So after some portion of this coverage provided by a carrier, and after that another carrier, so the tower mechanism established at this period. And when we look at the information gathering, actually it's worse than the previous era because the demand is huge. They don't have resources to go and check all the companies, to check their internal systems. They mostly relied on the surveys, questionnaires, the checklists. And then also they used data from public data breach information, and also the information from the cloud providers and other service providers. The incentives mostly in this age are breach panels and early attorney engagement aimed at the lowering the litigation costs. The third era is a big change, and I think everyone is familiar with this part. After 2018, we started to see many ransomware incidents. And this time, from third party to shift again to first party coverage, such as downtime coverage and the wire fraud coverages. And when we look at the claims exposure, we see that since the ransomware payments are very high and very costly on insurance companies, they started to heavily rely on reinsurance at this stage. And in terms of information gathering, they wanted to see a better and more accurate picture of the insureds. So they started to do external scans, non-intrusive scans, and the MGAs started at this time. And if you ask me about the MGAs, I see some of them more like a cybersecurity company than an insurance company, because they use all the cybersecurity tools to quantify and predict the risk before the incident happens to keep the claims ratios low. And they also used vendor data feeds as well. And at this time, the incentives, it was a hard market, so we see that most insurance companies don't sell cyber insurance if the buyer doesn't have MFA or EDR. MFA is multi-factor authentication. EDR is an advanced solution, an advanced version of antivirus. You can think it like that. If they don't have it, the insurance company say that you have a high risk, so I will not cover your risks. I will not sell policies to you. You can look at this chart from Howden Global. You see that the yellow dotted lines are the cyber insurance pricing index, and the blue line is the ransomware payments. So you see the correlation. Before the ransomware hits, it was very stable, the premiums. But after the ransomware hit, it becomes aligned with the increase of the ransomware costs. These two charts also gives us a very good information about the evolution of the market. So since 2018 to today, to 2024, you see the first 5 years, there's a huge increase in the direct written premiums. In this huge increase, the reason is it is driven by the ransomware. But the last 3 years, it's mostly stable, and first time this year, there's a 2% decrease in the direct written premiums. This doesn't mean that the cyber insurance market is not attractive as before. Still it is, but this time it is the issue is some of the large buyers, big buyers, move to self-insurance or captive insurance. This is what we guess. And when you look at the pricing for showing the percentage of change, the policies in force. So you can see what I can say about it is the Chubb and Beazley are still the largest players, but their market ratios are low. with the introduction of the new players into game. And AXA and AIG is still big, but they have a very volatile growth and loss ratios. Now, it's reinsurance. Reinsurance, I call it the hidden engine behind the capacity, especially after the ransomware era. During the ransomware era, mostly the carriers relied on them. For a typical P&C market, the carriers use reinsurance for 12 to 14, 15% of their portfolios. In cyber, it's around 50%, because it's very fast-changing environment, and there's a skepticism about the risk models. So what the coverage, usually coverage of the reinsurance follows the primary wording, and there are two methods for reinsurance. One of them is quota share treaties, which means reinsurer takes on a fixed share of the both premiums and losses. The other one is excess of loss arrangements, where the insurers step in only if loss exceed a set threshold. So what I can say about this part is also there are four main reinsurers, so it's very condensed. It might be an issue if one of these reinsurers stop providing the product, and sustainability of the cyber insurance market might be in question, because there are only four major providers. But reinsurers are not just providing capacity, they also discipline the cyber insurance, because they ask more clear exclusions and better risk modeling. These are the disciplines they brought. And for example, after 2018, they realized that there's a huge silent cyber, which cyber incidents are covered under other policies, liability policies, general liability policies, or business interruption policies. One of the major incidents is NotPetya. The global impact is $10 billion. More than half of it is covered by non-cyber policies. So this is a huge impact. So they realized they force more exclusions and more robust product. Cyber warranties is not an insurance product, as I said before. We started to see them after 2014. The vendors of software say that, okay, I'm backing up my product, and I say that I'm supporting my product. If something happens, if my product is hacked, I will cover you. I will cover you, but these are small amounts, up to $250,000. And these are strictly connected to some other mechanisms, such as endpoint tools. If there are no endpoint security tools or backup services, or sometimes even managed service security services, they don't cover. It looks like more of a marketing tool than a risk transfer tool. And some of them are backed by insurance companies, and we see that they are very hesitant to pay it, or it's not easy to get the payment from these cyber warranties. CrowdStrike, one of the largest cybersecurity companies, they said that for their products, they haven't paid anything for the warranty they provided. Parametric coverage is one of the important innovations of the cyber insurance industry. We see this after 2019. In this one, there are a fixed payment amount for a predefined trigger occurs. There are two major things. GDPR, the European privacy law, they report the data breaches. If something is reported in GDPR, so they cover it. So there is no self-reporting by the insured. They just follow the GDPR reportings, and then based on that, they cover the losses with a fixed amount. The other thing is the cloud outages. They don't need to ask any insured. They can just check the major cloud services. If their outage amount passes a certain amount, then they can trigger it, and then they can pay it. This is great, especially for small companies, because small businesses or medium-sized businesses, they value fast payouts and less procedures. But when we look at this, this is a very limited option, just covers these two types of losses. Capital markets, we started to see capital markets in cyber cat bonds after 2023. It's still a small size market. The first cat bond released in 2023 was 45 million, and now it's around 160 million. The good thing is the new money came to the cyber insurance sector, but to back up. But the issue is it's still new, and but there is a potential to grow in this area. Now I want to very briefly touch the cyber risk modeling and pricing methods. During all this evolution, you might wonder, okay, how we model and risk the prices. These are not just from the industry applications, also from the academic works. So one of the cyber risk modeling and pricing method heavily used is simulations, especially when we don't have enough data and we want to calculate the risk, model the risk for correlated or systemic events. These simulations are very useful, but they are heavily rely on assumptions. So the reliability of the results, questionable. The game theory is a useful tool if the risk depends on the behaviors of others, such as attackers, defenders, and maybe regulators. So these are also good, but downside is that the models often oversimplify the reality, and there are many assumptions. Network models are the primary used to model and price the systemic risks. They use the models similar to the epidemic models. But as I said, because of the lack of data, this might be that there's an oversimplification here. And case studies for exploring the extreme and rare events where we don't have historical data. And you can look at the evolution periods I shared with you. Even we have the historical data, this data might not make sense today. Because before the ransomware, there was no ransomware data, and when the ransomware started, it changed the whole sector, whole cyber insurance sector. And if something similar happens, for example, with AI today, then our historical data for the last 10 years wouldn't make much sense. So this is one of the things which makes cyber a hard issue to insure. And yes, the case studies exploring the extreme and rare events, we don't have historical data. It's useful, but as I said, it heavily relies on expert judgment and assumption. Statistical analysis are good. They rely on data, but the data can get very quickly obsolete. Non-intrusive risk scoring is, there are several companies provide this scores. Sometimes insurance industry relied on them. I don't know how much they rely on it now, but I think they still use it. These companies' scores are very, they're not converging, they are very diverse. For an insured, a buyer, one of them said good security posture, one of them might say bad security posture. And AI and machine learning, we started to see more examples now. And there are several data sets here. I will not get into the details, all of them. Some of them are paid, you need to purchase it. Some of them are publicly available. The issue about the data sets is they're kind of biased. They rely on the publicly available data, so they cover mostly the large size companies, less information about the small size companies, and there is a lag. For example, if an incident happens now, so they use the publicly available data, they can add to the data set maybe in next 2 years. So there is a gap. So this is also another important factor about the quality of these data sets in terms of creating cyber insurance products. So I said there are several reasons to insure cyber. One of them is the correlated losses. In property insurance, you can diversify geographically. If an hurricane hits Florida, it's very unlikely to have some losses in the property insurance policies in Ohio. But in cyber, this is not the case. As long as the companies use the similar software, it can hit all of them. Especially the systemic risks make it the correlated risks harder to calculate and handle. And there are immature risk metrics and risk methods. As I said, the 50% reinsurance rate is very high because this is what one of the carriers said in an interview with me. 10 years ago, the risk models were very divergent, so they didn't trust them completely or very highly. Now, when they look at the risk models, cyber risk models, they're very much aligned, so there are some suspicions about it as well. Because of that, they buy 50% around reinsurance. And the coverage uncertainty, unclear boundaries of war and critical infrastructure exclusions can drive some coverage disputes. And the event definition is tricky for supply chain and common vulnerability incidents. Because of all these things, insuring cyber is hard. But still, market is growing and it looks healthy. Now I want to continue with the second part, catastrophic risk and insurance, and let's discuss what makes it an incident, cyber incident, a catastrophic incident. For the rest of this part, I will use data collected from the Department of Treasury's request for information they released in 2022. They asked a question for public and they collected data about which factors and conditions elevate cyber incident to level of a catastrophe. Does cyber insurance market have the capacity to handle such event? If not, what can be the solution, such as the federal backstop? What kind of solutions? So when we look at the answers to this RFI, I used this data because it was a good data collected and it brings the perspectives of different stakeholders, carriers, reinsurers, intermediaries such as brokers, also cybersecurity companies, trade associations, and critical infrastructure owners and operations, which have difficulty in buying this insurance today because of the exclusions. So the first thing is loss size. Some of the respondents to this RFI said that if, like similar to TRIP, if threshold such as $200 million passes, it should count as a catastrophe. Dispersion is also important. Catastrophic affects thousands of organizations across multiple sectors, should count as a catastrophe. Critical services such as the power grids, healthcare, financial networks, if they are largely affected, it can be counted as a catastrophe. And the physical and irreversible effects largely affecting the many organizations, such as data wiped permanently, physical damage to infrastructure, and long time recovery times, this might be counted as a catastrophe. And systemic threats, such as one exploit can cascade through the shared software, cloud providers, and supply chains. And the rarity framing, if an incident which might happen in 1 in 100 years or 1 in 200 years, it might count as a catastrophe. So when we look at this survey result from the Geneva Association, from the reinsurers ranking of extreme scenarios, the reinsurers see that the top catastrophic extreme cyber scenarios are this denial of service, the service disruption of a large war, a malware epidemic, or a global ransomware attack. These are the top choices. And in the middle, cross-sector IT outage, IT failure. And they see the disruption of local and state services a lower likelihood than others. Some near-miss events, these are real events. You see that 2 of them are from 2017. WannaCry is a ransomware attack. The global loss was $4 billion. NotPetya, the global loss was $10 billion. And CrosstrTrack outage, it was last year. It's not a cyber attack, but it's a system outage, and by a malfunctioning update released by the vendor CrosstrTrack. For the Fortune 500 companies, the loss was over $5 billion. And CDK Global, a software used by the auto dealers, just affected North America, US, and Canada, and the loss was $1 billion. So we can see that just single incident can cause billions of dollars losses. I will not get into the details of these risk scenarios. There are several studies by insurance sector and sometimes in collaboration with academia. They see that if the ports are under attack, the maritime ports, what will be the loss ratios and how it will affect the insurance sector or a global ransomware attack. So they measured they came up with some numbers like the loss ratios around $200 billion to $3.5 trillion. These results and scenarios are questionable because we don't see the model sensitivity or lack of empirical validation. And there's also market influence because these are mostly backed by the insurance companies. So there is also some skepticism and criticism about it. So they might want to more tendency or support for government backstop. So they're releasing this kind of reports, and in these estimates, this might be biased. But still, these are the studies we have. This is from Guy Carpenter report, the model losses for extreme cyber events. You see that these are the three major cyber risk modeling companies, CyberCube, Guidewire Science, and Moody's RMS. You see that the loss ratios are very diverse. For global incident, which return period is 1 in 50 years, CyberCube says the expected loss is $24 billion, Moody's says $6 billion. For example, the US 1 in 23 years, Guidewire says $18 billion loss, CyberCube says 23, and Moody's says 10. You see that there is no consensus or convergence between these numbers. So this makes the carriers and reinsurers skeptical about these models. So the question, can the market absorb cyber catastrophe? When we look at the responses from multiple stakeholders to this question, to the RFI, the request for information of FIO, we see that the stakeholder shows a clear divide. So they see that the private market manages attritional loss as well. So that doesn't look like a problem with this. And the numbers, the NAIC data, the cyber supplement reports also show this. And many stakeholders say the private market alone is not enough for the very largest events, the events I showed you. Some hypothetical, some real, but if the size of these real events triples, it might be, or 5 times, it might be really hard to cover it. And there's an appetite gap, so there's limited interest in infrastructure outages or confirm the covering the state-backed events, because there's a war exclusion very common now. And there are tools used to cover the skepticism about used to manage or mitigate or assess these risks. So as a result, there's an interest in federal role focused on tail risks and exclusions to help insurance industry to cover catastrophic cyber risks. So this is shareholder views for the cyber insurance backstop based on this, again, this request for information. You see that carriers are skeptical. 25% says they support, 33% oppose, and 42% they don't say anything. They are undecided. But when we look at the intermediaries such as brokers, they hugely support it. 78% of them supports. And other stakeholders, particularly the critical infrastructures owners and operators, they highly support this federal backstop because they have difficulty in buying a reasonable cyber insurance product. What they say is they pay more, they get less, but they carry a higher risk than other sectors, of course. So if the capacity is enough, what models can be favored? like there are several models proposed, such as TRIP type model, or expand the TRIP and just add cyber into the current TRIP, or a model like UK's Pool Re, or National Flood Insurance Program type cyber insurance backstop. These are some of the methods, and now I will get into the details of these methods now. So the first question is, what can be the government's role for an intervention to cyber insurance sector and supplying some more capacity? So the first one is address the supply limits and high capital loads for tail risk. Private insurers and reinsurers face high capital changes when covering the correlated cyber risk, so this support will help them. The second one is support the continuity of government services and economic resilience. Once a catastrophic cyber incident happens, it will not affect just the private sector. Because of the cascading impact, it will affect the government services as well. So if there is cyber insurance coverage available, then the insurance sector can help the affected parties to recover. It brings more cyber resilience and it brings more economic resilience. And it will reduce the protection gap. The cyber protection gap is really large now, and with many firms underinsured, this challenge is close the gap in a way that supports rather than replaces the private carriers. And it will promote risk reduction where it's more cost effective. So let's get into the details, the advantages, disadvantages of these proposed approaches. The first one is government as the primary insurer, like it's similar to the National Flood Insurance Program. In this one, if there is no carrier support for cyber insurance, government takes their role and sells the insurance, provides the insurance. But in this case, the insurance is very tightly connected with the mitigation strategies. The advantage is, since it is it's tied to the mitigation standards, so it will increase the security posture and reduce the risk level. It will help to mitigate the risk. But on the other hand, it will, as a disadvantage, there is a risk of crowding out the private capital and innovation, because since there is this product available, the cyber insurance market might not want to innovate and provide a solution to this sector. And yes, the next one is a terrorism risk insurance program-like approach. Here, government as the reinsurer of the last resort. Let me explain how it works. First, the private carriers write and service the policies as usual, but the government provides reinsurance about a defined threshold. But before that, the carriers retain a deductible, the 20% of their previous year's premiums for the trip lines, and then there's a cost share. After this deductible pays the losses, and then 20% still paid by the insurance industry, 8% paid by the government. In TRIP, the cap is $100 billion for the government payments. The advantage, it stabilizes the availability and pricing, and it has worked well for the terrorism insurance, but there are some disadvantages or challenges for cyber insurance, because cyber attributions makes certification harder, if this is a catastrophic event or not, because under TRIP, the Treasury Secretary must certify an act of terrorism. In cyber, attributing responsibility to a nation state or group is politically and technically very difficult. The next one is Pool Re approach. This is an approach created in the UK in 1993 after IRA bombings. It's public-private pool backed by the government. So how it works, insurers cede defined layers of risk to the pool. The pool pays the claims and funds itself through the member premiums, but may by retrocession. And if losses exceed the capital in the pool, the government backs it up or sometimes provide loans or guarantee. So this is how it works. The advantages in the UK, it worked well for the last 30 years. The system, this pool, paid in the UK $635 billion for certified terrorism losses, and they didn't tap the government funds. All these losses paid from the money in the pool. So this also puts some of the pressure on the private sector, but also provides less contribution from the taxpayers' money, but also this provides a good and centralized risk-sharing structure. The disadvantages is it requires a new governance and eligibility rules and potential session mandates, and moral hazard might be an issue if pool pricing is not strongly risk-based. Another approach is ex-post disaster relief and compensation funds. This is similar to the covering the victims' losses after 9/11. So how it works, the payments are appropriated post-event. They can be formula-based, sometimes require waiving litigation rights, as in 9/11 victims' cases, and can reach both insured and uninsured entities. The advantage is useful when triggers are fuzzy and events are unprecedented and can target the most affected populations instead of everyone. So there's a flexibility at this point. But the disadvantages is it's slower and less predictable than the pre-arranged insurance and can weaken the risk reduction incentives. It causes moral hazard because it creates also fiscal uncertainty. Mostly, we see that the ex-ante insurance is generally more efficient in speed and incentives, also mitigating the risks and reduce the loss ratios than the ex-post relief funds. I will not get into the details. And now, before closing, I want to share a new approach just released last month or the month before by my colleagues at RAND Corporation. They call it CRIP, Cyber Risk Insurance Program. They recommend or suggest a mixed approach, which is composed of two towers. The first tower is dedicated to the perils that are mostly excluded today, such as like war, terrorism, and critical infrastructure outages. The second tower is for all other large-scale aggregation events. In the Tower 1, the purpose is address the perils that are widely excluded today in primary cyber insurance policies. How it works, the cost sharing, zero insurer deductible with a small copay, maybe 5-10%, and the 90 or 95% covered by the government if it's triggered. And it will be triggered if the industry loss amount exceeds $500 million or $1 billion, so it will be triggered. The rationale behind this is this ensures coverage is available where the private market currently excludes it, because there's a protection gap now, and while keeping the insurers modestly involved for discipline. When we look at the Tower 2 part of it, the purpose is handling the same non-war type of aggregation, such as widespread software or service failures, such as cloud failure. But this time, the cost sharing, the insurer's deductible set around 4 to 8 times of the previous year's cyber premium, and the above this deductible, insurer co-pays 20 to 30%, the rest covered by the government. And the trigger is if the industry loss ratio trigger suggested around 125 to 175%, which means that this is still extreme, but realistic events are covered under this. The rationale is the design relieves tail risk, but ensures the private market continues to handle routine and moderate losses. So, When we look at the participation and governance, we see that the cap should be around $500 billion in total, and participation should be voluntary for the P&C carriers. And event assignment certification should be done by the Treasury with input from DHS, ODNI, and FBI. So, in our so the baseline security controls are very important to reduce the risk level. However, the current studies showed that these security controls affect the attritional risk well to reduce the risk levels, to the claim rates lower and loss ratios lower. However, for catastrophic risk cases, there's a huge skepticism about the impact of these mitigation strategies. So such as multi-factor authentication, backups, or segmentation or incident response training. So for that, what we expect is the real value will come from the data collection, requiring carriers in the program to report incidents and claims into a central repository. Over time, this will allow for better evidence which controls actually matter. And this is a very hot topic now in the cyber insurance industry. So when I'm closing, some takeaways from the overall presentation. Extreme aggregation risk can exceed private capacity in rare cases, but it might happen. So the guardrails matter, such as industry retention, copay, and minimum controls. These are very important things to consider when designing a system. And state primacy is central, so any federal role should be limited, transparent, and tied to the certified systemic events. And what can be the near-term actions? There's no consensus on what is a catastrophic event, so there should be some definition for this, and the thresholds and loss definitions should be set and align a simple baseline of minimum controls for helping underwriting. Maybe an NAIC model law or some guidance documents might be helpful at this stage. And we need to define the retention rates, copay, and post-event recoupment tiers. And we need to run a cross-sector systemic stress test and share aggregate results and continue to do it based on the change in the changing cyber threat environment. So I concluded here, and we have 2 more minutes. If you have any questions, I can take it.
Thank you and all for the comprehensive information. And maybe you touched upon this, I'm not sure I quite got it, but my understanding is under TRIA now, cyber is covered, but some losses around that. Can you comment on that?
There's no consensus on it. It is, if a cyber incident is also a terrorism act, it might be, but not all cyber incidents are a terrorist act. So this is, I think it's not directly covered now. This is what I understand from my readings. But for some specific cases might be covered under it. But from a terrorist organization's standpoint, it's not directly about it, but terrorist organizations are not enough cyber capable to conduct a large-scale incident like that. The ones we discussed. Sometimes some nation states are behind them. Sometimes some cybercrime groups. But attribution is also a very big problem in the cyberspace. It's not as easy, or the established methods are not as good as or as accurate as for the other physical attacks. Yep.
I have a question. Thanks for the presentation, Unal. In some cases, when I talk to carriers, what I hear about when they engage with critical infrastructure companies is that the controls are lacking, so they don't have a proper security posture. So if you added a federal backstop, how would that address the underlying risk? I guess I just worry cyber insurance isn't the only issue for some of the critical infrastructure companies.
Yes, this is a very important point actually. There might be a moral hazard problem. So without a security baseline, there shouldn't be a federal backstop. This is what I can say. So we need to make sure that these companies, the buyers, have a security baseline. They use the controls, the main controls. But the issue here is we don't have a very strong answer to the question, which controls matters most? We don't know much about it. Still, there are some good studies, especially some reports from the brokers, a few academic studies, but I think the insurance industry reports are are better at this stage. But if there exists one day a federal backstop, there should be very clearly defined security baselines, particularly for the critical infrastructures, because an attack on a critical infrastructure, an incident at a critical infrastructure, is more likely to cause a catastrophic case. Yeah, I think we are done. Thank you for your attention and joining this session.